Ji, Assalamu alaikum, everyone. I'm Sohail Malik, head of ICAP Technical Department, and I'm pleased to welcome you to the webinar on the financial impact assessment of IFRS 17. We hope you have the program outline. However, for those who are just joining in, we have with us Umar Murshid Sahab, who is a senior chartered accountant, a leading insurance industry expert and chair of IFRS working group. You all know Wasim Khan Saab. So from SCCP, Wasim Saab is with us. And we are thankful to Ali Qureshi Sahab and Abdul Muid Saab, who are the speakers, representatives for today's webinar. And shortly, they will be taking us through the financial impact assessment guidelines and the template. We all know how significant IFRS 17 is in terms of the complexity changes and the implementation efforts. And keeping this in mind, the Institute's Accounting Standards Board has formulated a working group, IFRS 17 working group. And this working group has representation of the insurance industry, SCCP, and practitioners. And the Institute and the Accounting Standards Board is appreciative of the efforts that this working group has been making towards the implementation, supporting the implementation and ultimately the adoption of IFRS 17 in Pakistan. And today's webinar is also part of such efforts. We also know that SCCP has formulated a phased approach for implementing IFRS 17. And as part of this approach, it has recently issued the financial impact assessment guidelines, the template, and the submission timelines. And the purpose of today's webinar is to walk through these guidelines and the template. In today's webinar, we will basically have a look at the guidelines and the template. And we welcome the questions from the participants. For this, you can either post your question in the chat box, in the Q&A chat box appearing on your Zoom screen, or you can raise your hand by clicking the button, and the presenters will take your questions at the end of their presentation. Once again, thank you for joining in. And now I request Umar Murshid Sahab, who is the chair of IFRS 17 working group, and is also involved in various IFRS 17 implementation projects, to please share his thoughts on IFRS 17 and especially the financial impact assessment. Umar sir, thank you.
Thank you, sir. So I'm not going to take too much time. I think I'm just introducing the session just to try and understand what the purpose of the stage is. Shoaib Sahab already mentioned the SCCP as a 4-stage approach. The first was a gap analysis, which was already been submitted by all companies, and there's some learning certainly there. With the gap analysis, assume that people read the standard and then try to ascertain what they needed to do in order to move from the current IFRS 4 to IFRS 17 as a standard. The financial impact assessment has basically two major objectives. The first objective, obviously, is that because there's a change in the accounting standards, certainly for some, especially the life companies, there will be a difference in the actual numbers that will come there in terms of the insurance contract asset and liabilities that will be measured and the profitability that arises. So that is one of the objectives, to try and look at what is called the financial impact of introducing IFRS 17. So that is one of the primary objectives. However, there is an important secondary objective, and that is that although the gap analysis, one assumes that people will have gone through all the companies and the relevant personnel, the actuaries, the accountants, and the management will have gone through to try and understand what IFRS 17 is all about. But it's quite important that you could usually when you actually, although you might read something and try and understand it, when you actually try to apply it, that is exactly when you try and get to the depths of the standards and find out exactly what needs to be done. So it's a huge learning here, and a lot of the decisions that will eventually be made in the design phase, when you actually do the detailed design and the make out an implementation plan, that will effectively, you'll have to try and make an assessment at this stage. So the objective, I think, as the circular says, the objective is not to do the detailed design at this stage, but certainly you will need to apply a lot of the decisions that you will make. You'll try and look at them at this stage, and as a result of actually trying to attempting to apply those the processes, the methodologies, the processes, and so on, there'll be a learning, and hopefully that learning will mean that when the time comes to actually make those decisions, then there'll be a more informed decision, because you'll understand, what are the difficulties that are likely to come on later on in actual implementation, depending on the decisions you make with respect to whether it be the measurement model or the level of aggregation, how you make your portfolios and groups of contracts, and so on. So hopefully that will be an important learning that will then feed into the implementation design phase. The two gentlemen who are presenting today also have a huge input in actually putting together the template, right? The template itself has been based partially on similar templates that have been implemented by regulators in the Middle East, and so therefore there are a lot of Pakistani actuaries and accountants who've been involved in implementation assignments in that area, and therefore it takes into account the actual experience, meaning these templates have been used and have been successfully used in certainly the UAE and Saudi Arabia in the Middle East. So this is something which is there. I think Sohail Sahab mentioned that there are questions here. I think the ICAP has also put together an email address to which questions relating to the template can be sent later on, which will be discussed. But I'd like to thank both Ali and Mohit, as well as a lot of the colleagues who worked. There was a sub-working group which actually put together the template, so that's been very useful. And I hope that everyone will take. It's quite important that everyone in the industry does take this opportunity to try and actually use this as a learning experience, as well as obviously the primary objective, which is to try and see what the financial impact of each company is. So without any further ado, I'll hand over to Ali Qureshi. Ali is also the current president of the Pakistan Society of Actuaries, but over here he's wearing a hat as part of the work group member which put together this template. Yeah. Thank you, Ali. Please take over.
Thank you, Umar Sahab. Just give me a second. I'm just going to set up my screen here. All right. Thank you, Umar Sahab, and thank you, Sohail Sahab. I appreciate the opportunity to come here and speak on this template and walk through sort of the guidelines here. In preparation for this, both Mohit and I had a lengthy discussion about how to sort of cover this material, given the fact that it's a very large template and also very lengthy guideline as well that sort of goes with it. The intention initially was should we maybe evaluate putting together an additional PowerPoint to go through this material, but I think it was felt that to do justice to the entire exercise, I think it's best that we sort of go through the tough, I guess, part of actually going through the guideline, maybe line by line, and covering some of the thoughts that we have. I think we feel that it's a very comprehensive guideline as far as the template is concerned, but we feel that maybe just sort of going through it line by line may give us the opportunity to cover some additional points, and also maybe lend some structure to this entire exercise as you guys exit from this meeting today. So to the extent possible, we'll stick with these two documents. So if you see on the left side, I have the guideline open, which is exactly what was circulated by the SECP. And on the right side, we have the actual template that's also open, and we'll sort of, I think Mohit and I both have agreed to follow a similar format, and we will jump between the two documents as and when necessary to give more perspective. So starting on my screen here, as Umar Saab already mentioned, this is sort of a pre-exercise to the design phase, and in a sense, I think it very adequately covers the fact that this is really an exercise to get the, if you think about where the industry is, last year at some point, the gap analysis were submitted. We all had the opportunity to sort of maybe go through the standard as professionals and be it actuaries or accountants. And we also had the opportunity to kind of form some initial view on the standard itself. I think the main purpose of the exercise, as Omar Saab has mentioned, is to get our really hands dirty with the actual standard itself. So what it means is that you're actually interacting with reading all the various sections of the standard, reading the various guidelines that are available internationally, and sort of forming a view of some of the most important topics that are there on the standard itself. And hopefully this will sort of make you help you or assist you in making more informed choices and decisions when it comes to sort of finalizing your implementation plan. The FIU will be submitted to SCP in 3 stages. There will be 2 interim submissions. And then I think the overall timeline, I think Umar Saab and Mohit will probably, from the international experience, can probably point to, is longer than what we've typically seen in many of the markets. And I think this is just to cater to the fact that the industry is just sort of getting into this just now. There will be 2 interim submissions, June 30th and September 30th, 2022, which we'll discuss more in detail what the expectations are from each of those submissions. And there'll be a final submission at December 31st, 2022. So roughly, what we're talking about is about 9 months from the date of circulation of the template from start to end. Details on some of the requirements for these submissions will be found later in points 41 to 43, which we'll cover in detail. Obviously, these guidelines should be read with the template in hand. In terms of the measurement of insurance contract liabilities, this template really just focuses on all contracts that are sort of measurable under IFRS 17. So everything else is outside of scope. So this means that, for example, if you're looking at financials at 2020 or 2021 for each of your companies, they have to be, filtered out, and the focus should only be on the those items, basically insurance contracts, as defined under IFRS 17. And everything else should be excluded from the financials of your starting point and your actual analysis that you're putting together into this template. So in terms of where to start, I think the number one activity, or the first activity that needs to happen vis-a-vis this template, is defining portfolios. So I think, as this line mentions here, all IFRS 4 sheets in the template must be filled accordingly with a 1-to-1 mapping to their corresponding IFRS 17 portfolio. So IFRS 17 portfolio is where it all starts. I think what you need to, what each company will eventually need to do is, first of all, define their portfolios as per the definition in IFRS 17, which is similar risks managed together. And until you have that in place, this template does not really start off as a vis-a-vis. You can't really start off with this template. So the line of business definition is typically a good one, but I think this could vary by company to company, situation to situation. But that's where it all starts. And then from there, you go into separating them into under IFRS 4. So contracts that were considered insurance contracts under IFRS 4 but not under IFRS 17 should not be included in this exercise. This is an important distinction. There are certain contracts that were perceived as insurance contracts under, say, IFRS 4. For example, some of your fixed service fee contracts. You see these often on the health side in Pakistan, at least. Especially with respect to OPD and such arrangements. So those contracts now either move into IFRS 15, or some of the more investment on the life side, or the life insurance company side, you have the investment oriented contracts. Those completely, where there's little to no insurance risk, those move on to maybe IFRS 9. So basically what we're essentially saying is, yes, while we're looking at all your company or insurance contract data that's available to you in your systems as of, say, at the end of 2020 and 2021, you are isolating or separating out those contracts that are no longer considered insurance contracts under IFRS 17. So again, this is sort of referencing the definitions within the standard. The entire exercise sort of focuses on 2 dates. So coming to point 6, the opening balance sheet transition, which is at December 31st, 2020. And then subsequently building the P&L for 2021 and closing the balance sheet as of December 31st, 2021. The data at December 31, 2020 and December 31, 2021 has to be fully used, with the exception, as I mentioned earlier, of those contracts that will not fall under IFRS 17. So the intention is to not exclude any type of contract that would be considered an insurance contract. So when we say use all data, that basically means every single insurance contract in the portfolio needs to be sort of valued in. So this template needs to be filled in separately by each life and non-life insurer, including family and general takaful operators. For the purposes of this exercise, the numbers should include the respective takaful window operations of life and non-life insurers. Takaful contracts should, however, be grouped into separate portfolios from similar conventional contracts. So what this is basically saying, when you're separating out into your various portfolios, you really have obviously you're doing that line of business distinction that I sort of talked about earlier. But the other distinction that you're also making is the fact that the takaful contracts, although we have made a simplification that we'll discuss later, but the takaful contracts are obviously, say a motor insurance policy that is a conventional policy would be different from a takaful policy just because of the whole PTF arrangement. So for the purposes of this exercise, we want definitely, despite the simplification that has been sort of suggested within the guideline later on, we want the takaful contracts to be separately, or takaful portfolios to be separately kept from the conventional portfolios. So this is something that Mohit will also discuss later in his when he takes over. Each insurer will have to submit a separate FIA, a financial assessment impact FI report. Details are provided later in this document. I'll be covering them shortly. The template should be populated in line with the FI report. Obviously, what this is saying is whatever you're mentioning in the report, you're covering in, you're sort of actually doing in the template. So you're saying what you do and you're doing what you're saying. So I think that's really the intention here. The assets and liabilities at December 31st, 2020 go into the input IFRS 4 balance sheet in the FI template and will not match or fully reconcile with the published balance sheet on the same date, as only contracts issued by insurers are relevant for the FIA. For clarity, all business activity other than the business of insurance by the entity is not captured in the FIA. This is an important point because the expectation may be that, for example, if I go, I'm not going to this in detail at this stage, but just covering the balance sheet items here. So as you go across the sheet, you'll see this has pretty much only the insurance related items. So for example, many companies have other assets that they have within the organization, be it vehicles, intangible assets. There could be like your post-retirement, gratuity liabilities under IAS 19. So all of that, since it's outside of scope, you're basically recreating a balance sheet as of December 31, 2020 for IFRS 4 as well. So yes, while you'll be able to leverage as an organization some of the work that you did as of December 31, 2020 and December 31, 2021 to build your IFRS 4 balance sheets, you will still have to distill and carve out only those aspects that are insurance related. So एक तरह से आपको एक additional working करनी पड़ेगी even on the IFRS 4 front. This is just a disclaimer, really. The template has been designed, obviously, to avoid any errors, but you will notice that it's not protected. And I think, we clearly mark out the cells that contain formulas. So gray cells all across this template have formulas in them. White cells are all input cells. And then there's a check, I think a couple of, or maybe 1 or 2 check cells where you can actually see whether the reconciliations that are necessary in order to say that the template's been filled in properly, those are also in place. So while we again, all effort has been made by this, a lot of hard work was put in by the sub-working group to make sure that this was, error-free. But I think we've left room to say fix the formula if you see that is something that seems unusual or illogical. So the next section over in the guideline talks about the FI report. In the introduction covered, the FI report basically is sort of the final documents that's really due on December 31st, 2022. So we thought, in terms of structuring the guideline, we thought maybe let's start with the end in mind. And the end really is this FI report that will go with the template. The FI report has various aspects that need to be covered in detail. This is obviously, at the end of the day, these are all submitted to SCCP, and for readability purposes, let's just make sure we have all the abbreviations that we're using throughout the document covered upfront through some sort of say summary at the front of the document. We need to provide a business overview, so types of products, details of conventional and takaful products if the insurer also has, say, has a takaful line of business as well. Describe the data used for the financial impact assessment. These are just sort of your basic checks to ensure that, for example, your premiums, your ending, say, liabilities and assets are on be it like say outstanding claims, liabilities, and so on and so forth, claims paid, are all reconciling with the published financial statements, because there should be no difference there. And if there's any difference, let's just say because of the fact that we're excluding certain contracts that were there under IFRS 4, then I think what we just need to do is make sure that we explain that difference. So, for example, if you're saying that the claims paid is a lower figure than in comparison to the figure that was there in the published financials, then I think this just needs to be explained, that it's partly because of the fact that we've excluded, for example, contracts under IFRS 15. Level of aggregation and grouping of insurance contracts, along with the one-to-one mapping from IFRS 4 line of business products to IFRS 17 portfolios. I think this is, as I mentioned earlier, is the key. It's really just the starting point where you need to define your IFRS 17 portfolios, and eventually what you're doing is you're mapping them onto your IFRS 4. So defining the portfolio, अगर आप देखेंगे, within the template. Sorry, just give me a second here. So if you look at within the template, you have I think it's important to kind of keep in mind these green or dark green rows at the top first. So I think you just need to go because it's all merged and centered, centered. So what you're seeing is that it's mapped by the method first. So the GMM, which is one of the measurement models that is there under IFRS 17, PFA back portfolios, and then PAA map portfolios. What you're essentially saying is, अगर आप IFRS 4 की बात कर रहे हैं, so what you're saying is कि आप ये जो भी portfolio, let's say you could have portfolio 1 could be mapped to GMM, and maybe portfolio 2 and 3 are fully. यहाँ पे, for example, there's nothing appearing for portfolio 2 and 3, because portfolio 2 and 3 are mapped to PAA. So the intention is that you're actually separating out so your portfolio is not just by say by the line of business itself, but also by the measurement model that will apply to that line of business.
Ali, sorry,
yes.
sorry. Just received a comment. अगर थोड़ा सा वो कह रहे हैं कि हम slowly इसको
slow down a bit. Sure. Okay, sure. So for example, again, the idea, the reason I'm sort of maybe might seem I'm going a little faster is because I think sheet line by line jo coverage hogi, I think Mohit will be doing in the line by line to nahi, but like at least row by row, jo bhi major items hain wo cover karte hue, Mohit will go through it later on, because this is just sort of covering what's there in the report. But yeah, the intention really is that what you're doing is you're separating out the various. So let's just say if you go back for a moment to the first sheet where you're summarizing the portfolios. So if you think about, again, like I said, I don't want to eat into Mohit's presentation here, but so you're providing a list of portfolios here. You're saying whether it's a Takaful or conventional portfolio, because as we mentioned, we want Takaful portfolios to be separated out for conventional portfolios. Keep in mind, यहाँ पे हमने क्योंकि reinsurance contracts are measured separately under IFRS 17. The reinsurance contract portfolios will also appear separately here. Then you have the measurement model. This is where you're defining whether it's the PAA, the GMM, or the VFA. Again, this is covered within the standard, and I know it may seem even with cap analysis for time, but some of the measurement models were had to be discussed. In what I will say is, for most almost all 12-month and below contracts, it is PAA model. So most of the non-life companies will find that the PAA model is the fit for most of the lines of business. And some of the lines may apply GMM, and I think we'll again cover that later into this presentation. Then what you have is within those portfolios, you're providing the 2021 written premium. And I think this helps the SCB or anybody who's reviewing the template get an idea of how much business sort of falls into these various portfolios. So we have a separate sheet here for life and a separate sheet here for general business. So I think that's the idea that you portfolio define karenge, and then from there the template pe sara kaam shuru hoga. And this definition and how you're defining or aggregating these portfolios and how you're grouping these contracts need to be done at the very beginning of the exercise, and also covered and described in detail in the actual report. And I think काफी companies ने I believe probably ये चीज शायद already कर ली हो at the time of the gap analysis, because this is something that I think is sort of a starting point for IFRS 17, and this may have been covered by many companies at that stage as well. So maybe it just needs a refresher from many organizations present here. Basis for determining whether a group of insurance contracts is onerous. Again, this requires you to sort of go through the standard ki onerous ki definition kya hai, but loss-making contracts ki jo loss recognition needs to happen immediately as per the IFRS 17 standard. So what that basically means is that how would you define, or how did you go about defining what is onerous and what wasn't onerous? Onerous being, in this context, I believe maybe a good sort of substitute word would be, say, a loss-making contract. So it's a good definition again, because a lot of this, I think, important point to sort of maybe pause and sort of raise here is this, that the standard is very principles-based. And gives management room to define some of these things, and then as long as those things are defined as a policy, then and going forward, will carry karti into those things then become I guess the standard for applying this going forward. So maybe what we're sort of asking for here really is कि आप एक briefly अगर आपने कोई set up किया है criteria for determining what contracts were onerous, that is prescribed in the document or the FI report that finally comes. In the IFRS 17 measurement models, details of which methodology has been adopted for each portfolio, and particularly those which are long-term in nature in line with IFRS 17 requirements, along with the rationale behind model selection. So, यहाँ पे जो बात हो रही है, we're talking about again the three measurement models: the general measurement model, which is the GMM, the variable fee allocation, so the VFA model, and then you finally have the premium allocation model, so which is called the PAA throughout this template. So between these three measurement models, you're supposed to separate out all your portfolios. So again, आपने for example अगर किसी line of business पे VFA इस्तेमाल किया है या GMM इस्तेमाल किया है, you would have done it based on the definition and description of those models and where they are applicable as per the IFRS 17 standard, right? So you just then have to separate out all your business into these various measurement models and describe the where motor है, these are 12-month contracts and pay premium allocation approach लगती है, so PAA is the model, and why you're able to justify it as per the definition or description of PAA in the IFRS 17 standard document itself. The standard under paragraph 53A requires that insurers to perform a reasonability check prior to applying the premium allocation approach to a group of contracts. An insurer must determine whether PAA produces a measurement of the liability for remaining coverage that would not differ materially from the one produced using paragraphs 30 to 53. But for the purposes of this FIA, insurers will decide on whether to conduct this exercise or not and must specify as such in the report. So the idea really here is really, I think this is implied in this is a bit of a simplification that's been allowed for the purposes of the FIA. Because if the standard is adopted, you have to justify आपने ये test perform किया था to sort of apply. So the premium allocation approach is the simplest approach that's available in the standard to measure these contracts and provide for their liabilities for both incurred claims and remaining coverage within your balance sheet. So since it's the simplest method, it requires a certain test to be held sort of to justify we can use this methodology. I think in the case of non-life companies, again, because most of the contracts are 12 months, and similarly in the case of life companies, since most of the contracts on at least the group side, say group life and group health are 12 months, they'll naturally fall into the premium allocation approach. But some of the longer term contracts could also fall in those in that premium allocation approach, but then it has to be justified. So for the purpose of the FIA, all we're asking is you describe whether you've done this test, and if you have, then what were your findings? Maybe आप उसको support कर दें within your report. ठीक है. Again, current and future assumptions. यहाँ पे any assumptions that are used, say for the projection or roll forward, अगर आप देखेंगे, again when it goes into the Excel template, what assumptions were used, these need to be described in the report as would be, say, usual such an exercise. Details on other methodologies for FIA and how they were determined. So brackets may we've discussed risk adjustment, discount rates, the kafal per kya approach इस्तेमाल किए. So any other kind of major methodologies that were used. यहाँ पर the PSOA and the ICAP, I'll make note that PSOA and the ICAP are evaluating if we need to sort of provide some additional guidance or support on this front, and see maybe one or two topics where we might again, it's probably on discount rate and risk adjustment where we may probably issue some guidance at a later date, but that should not hold back at least the June 30th deliverable in any way, because a lot of that will follow, or the use of it will follow say some of the work that we've done for September 30th or beyond, जो December 31st की deadline है. So I think इसको कहीं guideline कहेंगे या maybe additional note आएगा just from either or both of the two bodies, the PSOA, which is Pakistan Society of Actuaries, or the ICAP, to cover some of the methodologies that may be say standardized by these two bodies, so just so that there's more comparability with the insurance companies' results. Again, if for all other methodologies that have been used, maybe say, for example, आपने अगर coverage units इस्तेमाल किए हैं, what kind of example, how did you determine what was the correct kind of coverage unit to use to project or say sort of amortize your fulfillment cash flows, or sorry, amortize your CSM. So uspe, I think the idea really is that you just able to provide some of that in the report. Explanation on the process of modeling and fulfillment cash flows. This is again mostly will apply to life insurance companies, and in the case of non-life companies, or say companies that are following the premium allocation approach, this may still apply to your liability for claims on the claim side. So इसके approach जो भी आपने इस्तेमाल किया, you need to cover that, describe that. Details of transition methodology, which methodology has been adopted in the FIA, along with sessions for the future design and implementation stages in terms of the data requirements, if any. So transitions, again, there are 3 transitions methodologies that are sort of described within the standard. Which of the 3 were selected? This may vary by line of, say, by portfolio as well, depending on what kind of data is available, because there's the fully retrospective approach, which is, I guess, one of the 3 approaches, and there's the modified retrospective approach, and then there's the fair value approach. So all of them have different requirements, and I think obviously the standard generally pushes towards the fully retrospective approach and allows for the other 2 approaches if it is impracticable to apply the fully retrospective approach because data is not available and other reasons. But यहाँ पे you'll have to sort of again cover that by portfolio, what the sort of the transition methodology was. Qualitative explanation of how reconciliation of CSM and revenue will be performed to depict the impact of the transition approach. Again, this is sort of covered. I mean, given the fact that we have a limited sort of time slot here, and the intention really is just to give an overview of the guideline. But I was sort of going through the standard, and we saw that sections say 114 to 116 probably cover this sorry, on this off the IFRS standard, the points 114 to 116 cover this, and then you need to sort of give an explanation of how that sort of applies. Similarly, simplification assumptions employed under the modified retrospective approach. This is again covered under C6 to C19 on the IFRS 17 standard. If where applicable, again, you have to sort of describe what simplifications were done. Methodology and basis for setting the assumptions for estimating the fair value as per IFRS 13 if the fair value approach is used for transition. Again, requirements to fair value approach reference is sort of leans on IFRS 13. And so in a sense, agar aapne, you're using that approach for some of your portfolios, then you need to again describe the methodology and the basis that was used for that. This is again covered in section C20 to C24. Then you get into describing the reinsurance approach, where applicable. Yahan pe again, it really falls into one of the 2 models. Yahan pe 3 nahi honge. It's either going to be the PAA or the GMM model, and as well as the method for determining whether a group of reinsurance contracts is onerous. So again, what was applicable on the gross level will also be applicable here in the context of reinsurance. So we need to kind of cover that and describe that for our reinsurance portfolios. Any simplification judgments used, this is just sort of generic in terms of maybe there's some sort of compiling of portfolios, the model points pe aap logon ne kuch analysis kiya, or in the case of life companies. So any simplifications that were done or judgments that were used need to sort of described here. Again, IFRS 17 results of P&L and balance sheet, along with comments in comparison to IFRS 4. This will be sort of automatically तरह से आपका template जब fill हो जाएगा, it will help you get this output for your report. And then uske niche, then you need to just make some commentary about what you're seeing on your P&L, what you're seeing on your impact on transition, and so on and so forth. Overview of insurance risk and other non-financial risks identified in the template. So again, in the case of say life insurance companies, you have mortality, lapse, expense sort of assumptions that are flowing into your non-financial risks. and any other financial risk or any other risk identified by the company should also be covered within this report. Sensitivity testing, based on the scenarios, define the template along with the commentary on the results. Again, there is a tab for sensitivity. Again, like as I mentioned, more we'll touch upon that later as we get into this section, the relevant section. And finally, this is supposed to be signed off by someone with sort of either the CEO or the CFO. In the case of all insurance companies, and as well as that, it needs to be signed off by the appointed actuary for in the case of life insurers. So those certifications need to be made at the end of the report. So I know this may be seeming kind of a little rushed, but at the end of the day, it is a standard that will require a deeper study, and that's really the intention here, because these are really all the discussion points or decision points that will emerge as you're designing this or you're going to get to the design stage for IFRS 17. So yeah, so I think going from the report to the transition section as of December 30, 2020. So as this is the case, I believe it is IAS 8 that sort of covers what needs to be done at transitions from one standard to the next. So यहाँ पे we need to work out an impact on the balance sheet as of December 31, 2020. Because what we're saying is that you've taken the impact at the beginning of the period, which is December 31, 2020, and then you're producing another balance sheet as of December 31, 2021, and a P&L for 2021 using IFRS 17. So the restated liabilities, restated ka matlab hua, restated from IFRS 4 to IFRS 17, shall be calculated as of December 31, 2020. You do not need to produce the P&L for 2020. But the FIA will be fully performed for 2021 P&L and for the balance sheet as of December 31, 2021. The income statement and balance sheet shall correspond to insurance contracts relating to all the underwriting years for 2020 and FY 2021 and must include all underwritten business of the beginning and closing years. Again, we do say all underwritten business, but obviously we're referring to those business that is considered an insurance contract. Okay. So anything that's been excluded will not be covered. But basically what it means is if there's, in the case of life companies, if there's a policy that's on your portfolio from say, or some business from your, maybe a line of business that's now discontinued perhaps and has policies issued from say in the 90s or late 2000s, whatever, that will still be in scope provided it's an insurance contract. So we're not excluding any business as far as IFRS 17 is concerned. The template requires two statements of financial position to be calculated to assess the impact of transition and equity and to assess the roll forward impact under IFRS 17. So the template, basically what it's saying is two statements of financial position, basically two balance sheet positions, one as of beginning of the year, one at the end of the year. So आपको दोनों populate करनी पड़ेगी to understand the impact on transition. And there's a sheet called the transition impact check tab sheet, which contains checks which you should make sure to review before you submit your spreadsheet. This will be part of this final submission. This again will be covered in more detail later on. On takaful, so this is another very lengthy debated point within the working group at ICAP. Case ko kis tarah humne leke chalna hai, because internationally firm guidance is not available. The OFI standard, I believe, abhi is in draft form, and I think is receiving is open to public comments. I think Mohit will confirm or this later on as well, which is the accounting standard from the Islamic sort of insurance accounting body. But usme ye hai ki what we've done is to simplify for the purposes for all takaful operators and any insurance company that's writing takaful business as well under a window or window setup. What we've done is we simplified the methodology a bit, and what we've essentially done is basically pretty much simplified to level where we're saying that the PTF surplus, which is this unique feature of insurance contracts, right? We've basically described that as an outflow from the perspective of say life insurance companies, so or even non-life insurance companies, जहाँ पे आपका अगर surplus emerge हो रहा है, वो आप एक तरह से उसको एक outflow की तरह इस्तेमाल करेंगे, sort of project करेंगे rather than, and then so in a sense what you're essentially doing is you're creating you're simplifying it to the point that it looks like an insurance contract as opposed to say a takaful contract. I think as I mentioned, there is a standard available or a guideline available, but again it's in draft form. But to get the companies working on this, we wanted to sort of make a simplification that's available to the Kafel operators, and again, window the Kafel operators as well. So the Kafel insurers are required to work on a conventional basis. So you combine the shareholder fund with the PTF and measure it as one. So this may require, again, perhaps additional work may be required on the Kafel lines of business के क्योंकि हम currently accounting separate हो रही होती है under IFRS 4 for the shareholder fund and the PTF. But for the purposes of this analysis, financial impact analysis, you have to combine them into one one contract. And I think this is quite a lengthy piece of over here describing what would be done in the case of variable fee and GMM type portfolios. But what it essentially, as I mentioned earlier, is it allows you to take, I think we mentioned it here at some point, cash flows as an expense item. So the expected surplus of the PTF should be modeled in the cash flow as an expense item and assume that the surplus determined each year will be paid out fully each year in the cash flows on an expected basis. So obviously this has to line up with your policy document. Again, I'm sure every company has a set up a PTF policy that's in place or surplus policy that's in place under the PTF rules. That should be used as a basis. Again, all of this predominantly apply to life insurance companies, not so much to non-life insurance companies. But we need, what we're essentially saying is that you do not need to separate out or segregate the cash flows from Wakala, because contract the separation hai nahi between shareholder fund and PTF. The Kafel insurers will calculate the CSM as a residual item after subtracting the expected surplus of the PTF from the fulfillment cash flows. Just as you would do with any other expense that or any other outflow, you're also treating the PTF surplus outflow as in the same way. The calculations will be done at the individual policy level and aggregated at the group of contract level within each portfolio, which is again the case with just as you would do this for all conventional portfolio. आपको यहाँ पे for the Kafel portfolios भी ये करना पड़ेगा. Given that in IFRS 4, the surplus deficit is determined after considering the impact of reinsurance, the expected surplus in IFRS 17 cash flows will also have to be considered as net of Read the Kafel only for the relevant cash flows, and therefore in the Read the Kafel models of those products, there will be no impact of surplus deficit in the IFRS 17 liabilities. So what we're saying here is, if you're looking at the expected surplus, because आपका जो सारे जो reinsurance cash flows होते हैं, currently they go into, or Read the Kafel, cash flows होते हैं, they flow through the PTF. So be it the Read the Kafel premium, Read the Kafel, claims. So वो सारा आप, again, because we're aggregating the PTF and the shareholder fund into one sort of account really, तो वो चीज़ भी एक तरह से merge हो जाएगी. If under any IFRS 17 cash flows modeling, this expected PTF payout will be determined as negative, essentially execution on qarz hasna, then it will still be considered as a positive amount as an expense, so that the CSM should be reduced with the qarz payment. Again, I think this is basically what we're sort of saying is, again, if your modeling is showing that the PTF, I feel most life companies case this is not really applicable because the PTFs are generally showing healthy surpluses, at least on the individual side. But nonetheless, if there is a situation that your projections are showing that there will be a qarz hasna that will emerge, then it should be adjusted as a positive amount so that the CSM will reduce accordingly. For PAA, the calculation will be done at the total contribution level, gross of Wakala, again, just for the same reason that PAA again applies in the case of all non-life insurers, or at least most non-life lines of business. The calculation will be done at the total contribution level, and the expected surplus and deficit will be considered as part of the PAA calculation of the liabilities. So expected surplus deficit, here we're talking about the PTF surplus and deficit. So maybe everybody may want to make a note here. So the expected PTF surplus will be considered as part of the PAA calculation of the liabilities. If the contract or group of contracts are onerous, then it will be treated as conventional and the loss component needs to be set aside. Again, the concept of loss component applies in the context of onerous contracts. I think this is something that sort of will need to be brushed up by the audience as they're going through the standard. All of the types of the Kafel payments, such as Mudarif, share, Wakala payments, etc., will be ignored. Just again, because of the fact that we're merging everything, the concept of Wakala, at least for the purposes of this analysis, it goes or is sort of it does not necessarily apply in this situation. So yeah, so I think the Kafel there is a significant simplification that's been sort of made. For those of us who are want to get a deeper idea of what the EOFI standard is suggesting vis-a-vis IFRS 17, I think the IFRS 17 working group within the ICAP is also going to be essentially eventually kind of referring to them for at least or referring to that guideline when it finally is issued. हमने उससे काफी simplify कर दिया, but for those who want to look at that, I think that could be useful as well in terms of understanding how the CAFL contracts are likely to be interpreted under IFRS 17. A lot of this information, I think, Mohit and I were discussing with ICAP and SCCP as well, that I think we'll probably compile maybe through an email, circulate a compilation of certain guidelines that we think that are important and are publicly available. Because again, most of the global, say Western global insurers are currently taking and adopting IFRS 17 as of the end of this year. So what's essentially happening is there's a lot of guidance that's already available on Google. So Google's really your best friend in terms of getting some of the information that's necessary to support the filling and the filling of this template, and the calculations that you need to be done, and also finding the modeling and the results that and what they interpreted can be interpreted as. So, but what we'll try to do is put together a sort of a list of various guidelines that could be useful on various topics, and that could help facilitate the completion of this template. Other areas, so again, this is sort of another simplification that's been done for the FI exercise. Like I said, I mean, perhaps the goal was to get people to sort of work with the standard, as opposed to really, some hard accuracy vis-a-vis the financial impact on your individual companies. So what we're essentially saying is we're throwing out both the tax impact. We're throwing out the separation of shareholder fund or policyholder investment fund. We're creating one fund for the CAFL. We're also not sort of factoring in statutory accounts. So what we're essentially saying, solvency also is ignored for the purposes of this analysis. So you're just looking at accounting profits and accounting balance sheets, and don't necessarily bring in solvency. Again, this is something that probably will not be the case when you actually finally implement the standard. Well, in fact, it'll definitely not be the case. But this is, given the fact that we just have a certain timeline that we need to do all of this in, it was felt that these simplifications were appropriate at this stage. So finally, getting into the template itself, I think Mohit will probably take over from point 25 onwards, but I'll just give a brief overview of the template structure. So for the purposes of the overall template view, I thought it could be useful to sort of just look at it in one screen as opposed to going tab by tab. So what I've done is, if everybody can probably still see my screen, I've summarized to the extent possible. Summarize to the extent possible the worksheets into one view, really, and what the intention with these worksheets is. So as you look down, really in the total workbook there are about 16 sheets. Okay, and within the 16 sheets, what you're sort of really emerging is that आप note करेंगे कि certain sheets within the names have the word input in them. So the input sheets are the sheets जिसमें actually each of our companies will need to input information. And जिन sheets पे input नहीं लिखा हुआ, those are sheets that are linked to the input sheets and therefore do not necessarily, unless for some odd reason there's an error of some sort, but they're formula-based sheets हैं सारी, जिनके against input नहीं लिखा हुआ. So these formula-based sheets will automatically populate based on the information that's input into the input sheets. So for example, if I just go down this column, you'll see overview life, overview general, info, IFRS 4 balance sheet, IFRS 4 P&L, IFRS 17 balance sheet, IFRS 17 P&L, balance sheet reconciliation sheet, and then sensitivity sheets are both, all these sheets are actually input sheets and will require work to be done to populate them. The rest of them will, so for example, complete balance sheet impact, complete P&L impact, and transition impact check. These are populated again from the input sheets. What I've done also on this is kind of broken the 16. I was hoping I could get a smaller mix of maybe 6 or 7 themes really. But I feel that within the template, you'll see 10 themes or 10 groups or need groups that can be formed within the entire workbook. So the first one is a simple one. It's just the instructions. It's high-level instructions to filling the template, and makes reference to the guidelines that have been issued, the PDF document that we were looking at earlier, for more details. So it also talks about how the plus minus wala jo aspect hai, kaun se, what items should be entered in the positive, what items should be entered in the negative, so that the template formulas work appropriately. Then you get into the input of the various sheets, which is the life general info sheets. Usme aap basically company ki, so the info sheets basically you're providing company and business information. You're providing an overview of your portfolios as defined in IFRS 17. Typically, this would be by line of business, but you have to evaluate separately for gross, which is conventional takaful, and reinsurance. So this is where you kind of describe this within your life in general tabs and the info tabs. You need to also make sure that you map each portfolio to one of the 3 IFRS 17 measurement models, which is either gross general measurement model, the VFA, the PAA, or on the reinsurance side, the GMM and the PAA. Then you get into the IFRS 4 aspects. This is the deliverable that is due on June 30th. इसमें आपको basically you have to separate out your IFRS 4 balance sheet, जो एक तरह से published balance sheet है, but again simplified to only restrict to the insurance contracts. And you need to do that for year 2020 and year 2021 into the different portfolios. And obviously, as I mentioned earlier, again, this needs to be done by measurement model. यहाँ पे we're also doing runoffs. So runoffs से मकसद ये है कि you were projecting these P&Ls going forward under IFRS 4 as well. So in the case of non-life companies, I think most of your contracts are 12-month contracts. So 1 साल का runoff होता है, whereby all your say unearned premium really gets earned. But you may have longer runoffs for some of your claims if if they're not necessarily settled say within a year. So 1-2 साल में we're expecting in most lines of business for non-life companies that will roll out or say run off. In the case of life companies, you'll find you need to actually get into say projecting beyond up to 2026 and beyond, because a lot of these contracts will still be there say 10, 15, 20 years from now. So what aspect needs to be covered here. So this is what we're expecting as of June 30th. Again, I'll cover the requirement later, a bit later. Then you have the IFRS 17 balance sheet and P&L. These are the balance sheet positions under IFRS 17 for year 2020 and 2021. Again, the P&L for 2021 and onwards. Same thing that you did for IFRS 4, but now you're doing it based on IFRS 17 methods and IFRS 17 standard. Complete balance sheet and balance sheet impact. These sheets just compile information from, so for example, if you're talking about the IFRS 4 balance sheet and the IFRS 17 balance sheet, these 2 sheets are built on these 2 balance sheets. So automatically will compile आपका year-end position for 2020 and 2021. And IFRS 17 versus IFRS 4 का आपको एक impact बता देगा कि net impact क्या आ रहा है from moving from one standard to the next on adoption of IFRS 17. So this is basically again a key sheet, a key output for each of our companies. Exactly what is the change that is impacting our balance sheet as of December 2020 and the final position as December 2021. Input balance sheet reconciliation. This is basically where you're reconciling your net liability. So let's just say as of December 31, 2020, आपकी insurance contract assets हैं और insurance contract liability है as of under IFRS 4, जो say published है as of right now. And similarly, you have a position under IFRS 4 as of the end of the year. Now, what we're saying is that we want to understand the reconcile कि अगर जो difference आ रहा है in your net position, so insurance contract asset less insurance contract liability, जो your net position है on both dates, इसमें जो difference आ रहा है, what are the sources of that difference? So again, as Mohit gets into it, he'll maybe discuss some of the items that will impact this reconciliation line by line. Complete P&L and P&L impact. Again, this is similar to the complete balance sheet and balance sheet impact in the sense that it sums up all the P&L across all portfolios into a single column. And then you have the P&L impact. It compares the P&L values and says sort of what's the percentage or absolute change in your P&L under IFRS 17 versus say IFRS 4. So yeah, so these are again sheets that are kind of built on these 2 IFRS 4 P&L and IFRS 17 P&L. Finally, then you have the last 2 sort of sets really, which is you have the sensitivity on the balance sheet and sensitivity on the P&L. We're talking about a sensitivity analysis on net liabilities for IFRS 4 and IFRS 17. हमने जो sensitivities अभी currently template में include की हुई हैं, those are mostly linked to assumption changes, loss making or onerous contracts, and risk adjustments. So what we're saying is, for example, अगर आपका discount rate या yield curve plus 5% या plus 1% plus minus 1% हो, अगर risk adjustment moves up or down, तो क्या impact आ रहा है on your net position? Just so that you get a bit of an idea कि what decisions are very critical to get, from your management's perspective, कौन सी decisions important होंगे vis-a-vis the measurements or the values that are showing up on your balance sheets. And similarly on the P&L एक analysis है, again on the same assumption changes or risk adjustment changes that will, and it show कि P&L पे क्या impact आ रहा है, under IFRS 4 पे क्या P&L होता है versus say IFRS 17 में अब क्या नजर आ रहा है. The final sheet before I sort of final run really before I hand it over to Mohit to sort of take us through the template itself is the transition impact sheet. Which basically what it does is it gives you a check for that the future profits and losses will be offset by the net liabilities upon adoption, by the impact on the offset on by the net liabilities upon adoption of IFRS 17. So what we're basically saying is the total profit under both total as in lifetime profit of a contract under IFRS 4 and IFRS 17 does not change. So let's just say that after, we're talking about a life company, the 10-year profit that will emerge on a contract under IFRS 4 versus say IFRS 17 will not be different on an absolute basis for the full 10-year period. But the pattern of the P&L will change. So say your year one profit will look different from year under IFRS 17 versus say IFRS 4. And so on. Year 2 में फर्क आएगा, year 3 में फर्क आएगा, but the total will essentially match. Now, because what we're doing is this exercise is being done in the case of especially, both non-life and life companies on contracts that are already issued. So what we're saying is there's a basic check that ensures that जो impact आ रहा है on transition and the future changes in the P&L will be offset so that the net impact will be zero over the lifetime of that contract. So again, when you start inputting some of these numbers, it will start making sense what the check sheet is doing. It may be difficult to imagine at this stage, but what it does is essentially kind of confirms if there's zero impact of when you look at the overall picture and the full position आप जब देखोगे, if there is zero impact, it confirms कि आपकी जो सारी working है within your template, it's sort of a really moment of truth hoga कि everything is sort of emerging as you anticipated. So that will be a final check on this entire exercise. So extensive requirements, and I think both from a reporting standpoint and the template standpoint, it is a lengthy exercise, which is why it's number one broken in, it sort of has a 9-month timeline, which provides us, even if we have our other financial reporting work that will probably emerge throughout the year, Q2 reporting आएगी, Q3 reporting आएगी, probably in the interim period, but it still gives us about 6 months to actually do all this work, even if you exclude, let's say, maybe 1 or 2 months for our other responsibilities that will probably be there. So, but the idea really is that we get involved and start engaging with the standard, start working on the template, and get a feel for some of the key decision points that will impact our organization's very important accounting results. So with that, I'll hand it over to Mohit to take over and through the detailed template and sort of help clarify some of the items that are there. Mohit, it's over to you.
Thank you, Ali. Thank you. I think you briefly explained most of the items, so thank you for that. So let me take the screen share. I think, Ali, you have to stop sharing screen. Ali, can you stop sharing? Thank you. All right, so can you just confirm, please? Can you see my screen? All right. So basically, again, Ali has already explained in very detail all the components, what exactly we need to do. I will explain about the template itself, what exactly we need to do. Basically, I think here we clearly mentioned that in the FIA template, profit loss account, we have to provide all income and revenue should be entered as positive number, as whereas all expenses or losses should be entered as negative values. So this is one comment that we when we will be filling IFRS 4 or IFRS 17 numbers. So this is the one area. Otherwise, it may be possible that we may face some errors that if you are entering in opposite direction, because the template has been designed in such a way that it assumes that expenses and losses are negative value. Similarly, on the balance sheet side, all gross items as well as reinsurance item as entered as positive. So we do not need to provide any in the balance sheet side any items as negative. So all balance sheet items will go as positive. I think there's just one typo there. I'm sorry for that. So there we say that all reinsurance is negative. So that please ignore that. All right. So basically, moving to the next sheet overview live. So I think again Ali has explained, and this template has been designed in a way that we cover gross GMM, gross VFA, gross PA. So all three measurement models will be applied on gross side, and then basically reinsurance. There is no reinsurance VFA. So either it would be reinsurance GMM or reinsurance PAA. So in this overview, I think Ali has already covered that we need to provide current line of business or portfolio separately for gross, separately for reinsurance, and even separately for the couple products. That what are the your life entity is writing. By the way, we clearly believe that this template needs to be built separately for life insurance company and separately for general, because entities in Pakistan are independent. Similarly, we will mention here basically what type of like portfolio type we will be classifying under, for example, under the IFRS 17 measurement model. So each and every separate portfolio, this exercise may have been done in GAAP, so that's okay. But whatever sort of mapping we are going to use, we have to specify for IFRS 4 and 17. Similarly, this is for general insurance. A couple of examples I think we also provided. I will go back to in the PDF, so I think I will go back to that. So on the general insurance side, we also have to provide gross separately, reinsurance separately. I think I also saw one question that for reinsurance, even on gross side or on like life insurance or general insurance, do they need to be linked or do they need to be independent? So they will be independent because one treaty may be covering different portfolio. So they will be, it's like gross will be different independent as compared to reinsurance. But obviously we have to provide, for example, if company is writing unit link business, let's say here, the unit link, the couple is separate, unit link conventional is separate, we have to provide separate. On the general insurance side, this also apply if companies are writing different like line of business for motor, let's say, and within motor there may be different portfolio, motor TPL, motor comprehensive. This is where we explain in the PDF the business composition, gross PA. So you may have motor TPL, the couple, motor comprehensive, the couple, motor TPL conventional, motor comprehensive conventional. So these types of like segregation we expect insurance companies to do, and then basically build this template accordingly. So sorry, I'm just moving from one sheet to the other. Although I can do the parallel comparison, but I thought that it may be useful to explain in detail by showing one slide. Okay, so as Ali also mentioned that basically we have to fill name of the company, type of insurance, project manager, who is the owner, then basically like who is the what is the designation of the project. We have decided that the transition needs to perform because this is the accounting standard first time to be adopted. So we have to restate our beginning balances such that your ending balances will be calculated accordingly. So in this restatement, we have decided to choose the date as the 31st December 2020, and the current financial period will be 2021. So in simple word, all transition balances on the liability side will have to be restated as of 31st December 2020. Here, basically, we also mentioned that portfolio 1 LOB, and some of the examples are given here. For example, again in VFA, reinsurance, GMM. So all these examples have been explained there, but we have to mention all the number of portfolios within gross GMM. On the right, you will see gross VFA. On the further right, you may see gross PAA. then basically reinsurance GMM and reinsurance PAA. So all your portfolios, they need to be filled here independently. All right. And whatever, by the way, we classify here, let's say motor TPL as a couple, and motor portfolio number 2 motor TPL conventional. So basically all numbers in the corresponding sheets, so basically they will assume this portfolio number 1 definition is exactly same. So in simple word, if I see, by the way, this sheet, this pattern, you will see everywhere the portfolio 1, 2, 3, 4 till let's say portfolio 20. And then basically we have like balance sheet 2020, because this is a transition balance sheet. On the right, we have balance sheet 2021. This is the current year balance sheet. So you will see basically this, whatever you define as portfolio number 1, so that will still remain in the same terminology. Please do not mix, let's say portfolio 2 numbers or working with portfolio 1. So that will be not give a true picture. So at the end, basically, going back to this sheet, so effectively we will explain all portfolios separately for GMM and BFA and PA side, gross and reinsurance. Then moving on to the next sheet, we have input IFRS 4 balance sheet. This balance sheet basically requires, again, as we mentioned, that we do not need to put non-insurance item. So you will not see any cash item, invested assets, because they are non-impacting IFRS 17 items. So we are just considering only insurance and insurance items. So here effectively we will have to provide our breakup of each portfolio with respect to these categories. So we believe that these are the information which usually available, but obviously whatever we redefine, for example, in the current, let's say you're working, you may have total motor. So now we are segregating into motor, into TPL, takaful, motor comprehensive takaful. So this definition will still, and by the way, this is illustrative, by the way. So this definition we need to follow here as well. So if we have defined in the input sheet, this is motor TPL takaful, then basically all motor TPL takaful balance sheet component will come here. And this is basically, again, you can see on the very top, this is like gross GMM mapped portfolio. Similarly, you will see VFA mapped portfolio. And if you go down, you will see PAA mapped portfolio. So basically, all those segregation, there are 5 major categories, 3 for gross, 2 for reinsurance, because VFA reinsurance is not applicable. So reinsurance GMM and reinsurance PA is also there. We have to follow them separately. Within reinsurance, the number of items are there. I'm not going, unfortunately, due to I think time shortage, I cannot go in detail, but I think we believe, by the way, that these all items insurance companies are familiar, because these are something like similar to IFRS 4. Similarly, on the basically P&L side, if I just zoom in here a little bit, so we have the current, you can say, format of the revenue income statement P&L, where we start with from gross contribution or gross premium. So again, I'm not going into the explanation, but the idea here is the same, that whatever we define as portfolio 1, let's say motor, so basically we will have to provide the same number, such that the one-to-one mapping will remain maintained. And again, we have, you can see here, basically we have a GMM. You can see again, by the way, the portfolio 1 till portfolio, let's say 20 for, by the way, P&L 2021. So in simple word, we, in the balance sheet, we are not sort of projecting the balance sheet until future, but for profit loss account, yes, we have to project balance sheet. So, and this projection is important. I will explain why for transition purposes. So here, basically, we have like all portfolios P&L 2021. Then we have all portfolios P&L 2022. And then basically we have all portfolios P&L 2023 and so on. So effectively, we whatever portfolio 1, if for example, motor, let's say it's just 1-year policy that may continue for next 2 years, that's okay. Then basically you will have to just provide 2021 number and 2022 numbers, and that's all. Because if motor portfolio will end by, let's say, within 2 years, One point we clearly mentioned in our guidelines that there will be no new business. We do not need to assume any new business, otherwise this will continue. So this business, just this template require all existing business only. So effectively, as I mentioned, motor for, let's say, maybe applicable for 2021 and 2022. So it may end in 2022. That's okay. And 2023 will remain blank. But for, let's say, unit linked life portfolio, which is there for, let's say, 20 years. So we have to obviously project for all policies, all portfolio for 2021 and moving on 2022, 23, 24. And here 26 and onward we club. So basically new projection model for the life companies where we believe actuaries are involved. So all 2026 and onward will have to be mapped and consolidated. So effectively, we still have to project total P&L for life companies using maybe actuarial model, but this projection will be there. And this basically on the right side, you can see all portfolio, and on the very top, this you can see again that this is GMM side. Then if we go down, we can see this. If you go down GMM, then we have VFA again. Then we have PAA. Then we have reinsurance, and again reinsurance GMM and reinsurance PA. And that will add. So all sheets have been designed in 5 categories, as I explained earlier. And so this is it. This is it. Again, this is like IFRS 4. So I think all items should be available usually with the insurance company. And this is, I think you can say, our first interim timeline as well, that you need to provide IFRS 4 number according to the portfolio that you are going to decide as per IFRS 17. So all IFRS 17 portfolio will be mapped accordingly. Moving on, IFRS 17 balance sheet side, the conceptual and the technical design is same, that you will have balance sheet only for 2020 and 2021, not for the future year. That's okay, because we do not need projection. You will also notice maybe that we are requiring balance sheet for 2020 and 2021. But in the P&L, there is no working for, let's say, 2020, because when you do the first time reinstatement, basically, again, I'm coming back to the P&L. So this is only starting from 2021. But in the balance sheet, we are presenting 2020 as well. So why? Because this is the transition. In the restatement, we do not need to project the P&L of 2020 as well. So that's why you're just calculating for the transition only the balance sheet items which are applicable under IFRS 4. Let's say your IFRS 4 liabilities are 100 million and IFRS 17 liabilities are maybe 105 million. So there's this 5 million impact because the liabilities increased by 5 million, so it will go and impact the equity. But we do not need to project 2020 P&L unless in future maybe we require comparative when we actually do the let's say dry run. So then comparative purpose we will need, but for this FIE we do not need 2020 P&L. So now the IFRS 17 balance sheet. So obviously because of the shortage of time, I will not be sort of able to explain the all separate item. But this is something like have been designed in terms of insurance contract assets, insurance contract liabilities there basically. And again, all assets and all liabilities are segregated in terms of 2 components. So liabilities for remaining coverage, this is you can say, and liabilities for incurred claim. Liabilities for remaining coverage is basically, again, simply for simplicity purpose, is for non-life company is simple, what we call as UPR and PTR, etc. For life company, it will be like in terms of mathematical reserve, but now we have new different component in terms of fulfillment cash flow, risk adjustment, and CSM. Here we also have the segregation of LIC for again discounting and the impact of risk adjustment. Due to again shortage of time, so I cannot obviously go, but I'm just highlighting how to fill the template. And basically, you will see that this is a total net liability again. So all assets, all liabilities separately for, you can say, on the gross side. So basically, we have again GMM here, then we have VFA, then basically we have PAA, then RA GMM and RA PA. All portfolios, and again, I'm sorry for that. So all portfolios and basically all items we need to provide accordingly. Then we have basically the P&L, IFRS 17 P&L. If I zoom in here, so IFRS 17 P&L basically requires again all future year projection. We have portfolio 1 till 20. We have like starting from 2021, till let's say 2026 and onward, where we club. Similarly, what we did in IFRS 4, we have to do in IFRS 17 as well. All portfolios will be there. All portfolios need to be combined, and not all portfolios need to be independent and exactly map as per you can say the whatever categorization we use. For example, again, motor TPL. Let's say motor TPL. Let's say basically the couple. So basically motor TPL the couple portfolio one here, and IFRS 4 motor TPL the couple will also be there. Similarly, so basically we have the P&L item here. In the P&L item, we have IFRS 17 components. For example, if some you can see by the way that this is GMM here. That's where the GMM components are absolutely different. Similarly, the expense side is different. Obviously, this is, you can say, IFRS 17 profit loss account. So all insurance company, they need to familiarize themselves by this new P&L, which is especially changing for life side, not significantly change for life, but slightly little less changing for the non-life company. And you can see again here, basically this is for again VFA. If I see here, this is VFA. Then we have the PAAs. PAAs, you can say, is not significantly changing because you can see insurance service revenue is combining as part of earned premium concept, and basically you have the insurance service expenses and so on. And this is basically for reinsurance GMM, and this is for again reinsurance PAA. Again, the concept is same. All portfolio, no new business needs to be filled. Nothing in terms of new business. All portfolio 1 to 20, whatever categorization we made, and then basically 2021 to 2026. So concept are same. Then we have this, and by the way, here you can say, I think first interim deadline, which Ali will cover again. So basically, we have this IFRS 4 P&L, IFRS 17 balance sheet, and then basically IFRS 17 balance sheet and P&L is separate. It's a second, you can say, third part of the working. But this part, like the complete balance sheet, right? So complete balance sheet means that you have IFRS 4 balance sheet, and this is automated here. You do not need to do anything. So this basically combine all portfolios for 2020 year and provide you all insurance related items as picture of the IFRS 4 balance sheet. And this is on the right is basically 2021 balance sheet. Again, this is just like 2020 and 2021 balance sheet combining all portfolio. It will come at entity level. And here basically you have IFRS 17 balance sheet. So IFRS 17 balance sheet for 2020, you can see all IFRS 17 items which are there. And similarly on the right side, 2021 balance sheet is there. If I move on and to cover, and these are automated sheets. You do not need to do anything. You can just review the numbers, whether the numbers are making sense, how there is an impact. Similarly, the balance sheet impact, this will explain insurance company management, basically how my insurance balance sheet for each portfolio, let's say portfolio 1 till portfolio 20 for IFRS 4 and IFRS 17, how much is the impact? So again, as I mentioned, maybe for motor TPL comprehensive, you have 100 million liability. For IFRS 17, you have 105 million liability. So that you will see 5 million impact. So sorry, liabilities are here. So you will see 5 million liability impact. So there may be insurance contract, insurance asset like receivable, or maybe like reinsurance side. So all these are combined here together, and then as a net, you will see the impact on equity. So again, insurance asset does not mean cash, invested asset does not mean at all, but only like reinsurance UPR. So they will go here and the side. Cross UPR will go here, reinsurance go UPR because of the asset, so they will go there. So at the end, you will get the impact on equity. And then basically this impact on equity is again separate for GMM. If you go down, you will see VFA. If you further go down, you will see PAA, and again reinsurance and GMM reinsurance PA. Moving on, balance sheet reconciliation. This is a new sheet where insurance companies will be required to justify. For example, I'm just taking one example. Let's say you are standing at GMM side, and you have to sort of, in terms of your working, how much, again, as I mentioned, to motor TPL. So 100 million was the motor TPL liability, and 105 is the ending liability. But what are the components where you arrive from 100 to 105? So this may be because of the impact of discounting. Maybe your risk adjustment has increased by 5 million. So whatever the methodology we have adopted, we have to explain. And this also applies to life companies. There's life companies. Obviously, we are moving from the current IFRS 4 methodology, NLP and GPV to fulfillment cash flow. So this is one of the area of having impact. If we are segregating any investment component from insurance liability, if we have like the change in other methodology due to maybe GM and VFA, so all these areas need to be explained. What is the impact and which component will give the impact. And so this need to be there for 2020 balance sheet side on 2021 only, not for in terms of P&L. All right. Again, we requested all items separately for each portfolio. And this is again, you can go down and you can see all 5 components again. In the P&L side, moving on to the P&L side, this is automated sheet. You will see that you have total IFRS 4 automated P&L. So you can see this is my IFRS 4 entity, you can say level P&L, and this combines all portfolios. So for example, portfolio number 1, portfolio number 2, everything is fully combined here. So basically, this is, you can say, the net picture of the total P&L for each year. Similarly, and by the way, this also combines PAA, GMM, VFA, gross, RA, everything. Basically, and the formulas have been designed in a way that they are hopefully, and they should not be an error, inshallah. And then as long as you provide accurate number in a way, for example, with sign convention as well. So as I mentioned, just ignore the balance sheet component, which we mentioned, I think by mistakenly here, that balance sheet is negative, but in the PDF side, we clearly mentioned that all items for the balance sheet will be in positive. Again, here we clearly mentioned. And in P&L, it should be positive. For income and expenses should be negative. Effectively, there are formulas that are applicable, and it will automatically calculate the profit and tax accordingly. And so basically, this will also combine gross and reinsurance and all portfolio. This will also combine IFRS 17 P&L, but this is a consolidated way because you can see insurance revenue had many components. For example, you can see again here, this is the insurance service revenue, this one. So effectively, this part, so basically this part, like 6 items, they have been combined in just one single line. Similarly, this insurance service expense, they have been combined again in one single line, and so on. And this is the net expense from reinsurance contract. This is, by the way, the international IFRS 17 presentation on an aggregate basis. So we are combining it that way. So this will give you how my IFRS 4 profit or loss will look like, and this will also give maybe very good picture to the board of directors, top management. This is my IFRS 4 P&L. This is my IFRS 17 P&L. How my IFRS 4 profit or loss will change, etc. Moving on, due to the shortage of time, I'll just quickly recap in terms of this is the P&L impact. You will also be able to see the impact of P&L from IFRS 4 to 17. This is again automated sheet. So each portfolio and again each year, by the way, you will be able to see how much is the impact. So this is like again 2021. So this is more granular. You can say more granular 2021, 2022, 2023, and so on. So this is more granular. As long as you are providing granular numbers, so you are also getting granular summary of the results. In the next sheet, basically we have sensitivity scenario for balance sheet and sensitivity scenario for P&L. One scenario one is best estimate. So whatever you provide as best estimate, that's scenario 1, you do not need to input anything. But in the second scenario, we requested to decrease the yield curve by 1% for all years. Obviously, it will change both IFRS 4 and 17 number. Then increase the yield curve by 1%, so it will change again. So this basically, once you change this yield curve, so this applicable wherever you apply yield curve interest rate, it will apply to all portfolio, and you just need to provide total numbers. You do not need to provide portfolio level information. This is just, although the calculation will be done at portfolio level, but this is just the summary. Similarly, if the risk adjustment increased by 5% or risk adjustment for LIC increased by 5%, then basically assuming that 15% of your total portfolio become onerous by 10%, assuming for future mortality assumption increased by 10% and thereby impacting CSM and future profit losses. Similarly, your expense increased by 10%, lapse rate increased by 5%, and lapse rate decreased by 5%. So again, these are some scenarios which will, again, this gives you the impact on IFRS 17 liabilities and IFRS 4. and it will be basically comparable in terms of how your assumptions will have an impact on your P&L and balance sheet. And this is a very, very good way of reviewing, especially for the board of directors and top management, that why my assumptions are sensitive, and how much is having an impact. So this is in terms of the P&L. So all scenarios are exactly same. I'm not going to repeat the scenario, but obviously you will also see the impact on P&L. So this is the last sheet in terms of transition. Transition, basically, this is just a one quick check. Theoretically and practically, whenever you, if again in my example, 100 million is the total liability for motor, 105 is the total liability of motor under IFRS 17. So this 5 million is an impact on your equity. So you will see 100 here, 105, and this that is 105. But obviously for the motor, let's say in my example, your future profit for the motor, given in my example, 5 million is an increase in liability, so it will decrease the equity. So this decrease in equity will increase the future profit, because effectively under IFRS 4 and IFRS 17, the total profit will remain the same. Yeah, they are not changing. So total profit will remain same, and this seems to be a timing difference now. So effectively, if you are recognizing negative impact of 5 million, so you will also see the positive impact of 5 million in P&L, such that your profit or loss will eventually remain same. And that's the, you can say, check we are applying there. So, and for life policies, again for unit link, so same thing apply. If you have life unit link, let's say 100 million liability, IFRS 17 liabilities are 110 million, or maybe let's say 90 million. Let's say 90 million. So, for example, there's a decrease in liability. So your liability will in equity will increase by 10 million, and then basically your future profit will decrease by 10 million, because again at the end the total profit remains same. So this is just one check. Again, insurer will be required to ensure that this is fully compliant. So I will end this session and hand over to again Ali just to recap the timelines, and then basically we will have the question answer session. Thank you for this. Ali, over to you.
Thank you, Mohit. I think so. Just quickly share my screen here again. So coming into, again, going back to the Word document here. So deadlines for the financial impact assessment. So as we mentioned earlier, all the IFRS 4 related aspects are due on June 30th. So so in order to complete the IFRS 4 related requirements, you need to complete the following sheets. So it will be the overview life or general, depending on whether you're a life or non-life company. The input info sheet will need to be completed. The input IFRS 4 balance sheet and 4 P&L will need to be completed. And sensitivity analysis with respect to IFRS 4 values only for both the balance sheet and the P&L will also need to be completed. Separately, what the SCB is seeking is a status summary report. The format is completely up to the company, but the summary report must comment on progress on the following tasks at the minimum. Decisions related to the level of aggregation for IFRS 17 portfolios. As mentioned, that's really just starting point. It's point 0 really in terms of how you begin filling this template in. Any details regarding the governance, steering committee, technical committee setup, including the summary of the meeting notes. कि अगर आप internal meetings हो रही हैं to drive this work within the organization, we just want to see, SCB wants to see it demonstrated. Transition related requirements of the FIA. If there's any thought put on transition related requirements, kya hongi, for example, which portfolio can flow through what, then maybe you can discuss that here, because that's really, agar aap interim submission 2 dekhoge, that's it's really subject, it's all focused on transition. So what the SCP is sort of seeking here is some idea on whether you guys whether work has begun on transition related aspects. Even if some brainstorming has happened, I think that should be briefed on with the status report. High-level comments on risk adjustment for non-financial risk, coverage units calculation, onerosity of any existing group of contracts at transition and any subsequent measurement, acquisition expense allocation, and overall, finally, a progress on the FI report, because finally, the document due here was the FI report. So the sales should also provide confirmation that FIA tasks and plan have been discussed with the steering committee and the company is in line with the SCB requirements to submit the FIA as per the timelines. So this is just another confirmation and checkpoint summary to understand that everything's moving at the right pace. We are still, as of June 30th, on time to meet the December 31st final deadline for the template itself. Then you have another template, say a submission due on September 30th, 2022. So what we're doing here is again requesting the IFRS 17 balance sheet and a balance sheet reconciliation aspects as well. So what we want to understand is what is the impact on transition from IFRS 4 to IFRS 17 on your balance sheet items. Again, with these two sheets, what we're also seeking is a summary report providing comments on progress of the following tasks. So note on transition, which should include comments on why the impact on debt liabilities or equity is positive or negative, along with the component level details, what kind of model building was done for each measurement approach, and what kind of assumptions were set, what was your IFRS 17 balance sheet position as of 2021, projection of IFRS 17 P&L for all portfolios, and sensitivity analysis relating to IFRS 17 scenarios. In addition, the summary report should also provide confirmation that the transition results, FII tasks have been discussed with the steering committee, and the company is on track to submit the final report as per the permitted timeline. And then finally, the full template and the FII report are due at the end of the year as of December 31st, 2022. So again, a 9-month timeline with 2 interim stops, which are June 30th and September 30th. And the final submission on December 31st, 2022. With that, I think I'll hand it back over to Suhail Saab, who can possibly say, run the Q&A session as needed.
And please feel free if anyone has any questions, to please write it in the chat box.
So I will start with the questions that have been posted. The first one is that regarding reinsurance, do reinsurance portfolio need to be in line with the gross insurance portfolios for FIA purpose, or can they be totally independent? So you can also see this question in the Q&A box.
Right. So as I explained, I think because I read the question, I was just giving a walkthrough of the template. So I covered this point that these reinsurance portfolio will be independent. Because again, maybe we can take one example that on gross side you have let's say unit link and maybe term insurance. On the reinsurance, maybe one treaty is covering both portfolio. So you cannot sort of bifurcate. So they will be still independent. One thing that, for example, if there is a loss component, that there is an amendment there in the standard in the final version. So if there is any loss recovery components, that they can sort of reallocate the cash flows. This is something like technical point if someone wants to say. But in terms of this, it will be independent.
Right. Thank you. Then the next question is that as far as the balance sheet reconciliation is concerned, life insurance companies in Pakistan, many hold cash value reserves on unit-linked portfolios, policies. Reserves are not based on GPV, and therefore balance sheet reconciliation may not be possible. So what is your take on this?
Okay, so basically, I think someone is okay. So basically, here we need to, I think, see that basically what we are doing in IFRS 17, basically something, it's not just linked with the cash values, because in unit link we have the cash value, and those cash value, for example, if you apply, let's say BFA, so basically you still have to apply all the numbers cash value IFRS 17 FCF for working. So for example, in the fulfillment cash flow, there are two again method for BFA, direct and indirect. So either method, basically you have to project the cash flows, which include the unit link component part, and effectively at the end, in IFRS 4 you are not applying GPV. That's okay. For example, if IFRS 4 you have total unit liability of, let's say, maybe 100 million. In IFRS 17 you are still projecting FCF and projecting the unit liability as part of FCF, and then you will compare 100 million of IFRS 4 unit liability plus any mortality charge, let's say, in IFRS 4, and then basically you will compare with the FCF. So basically that's where you will still be able to do balance sheet reconciliation. So I do not see that if you do not apply GPV, so you cannot do reconciliation. I don't think so. It is still applicable.
Right. Thank you. We have few other questions in the chat window. The first one is that as because SSCP has interim submissions and the timeline. So the question is that how companies would show the progress report in June and September.
Again, the progress report so is it, you think it's, I'm trying to clarify, but probably if you're looking at format, हमने कोई format prescribe नहीं किया है, but we're looking for some kind of summary of progress that's been done so far and projected progress आप क्या foresee कर रहे हो on some of the key items that have been listed within that document. So this is more of like, again, we यहाँ पे हमने, we deliberately left it open to the companies to cover it in as much detail as possible, but at least cover some of these key points जो हमने minimum में एक तरह से हमें कहा है ना कि minimum in points पे comment करना जरूरी है. The intention SSCP has here is to sort of make sure that there is some thinking happening on some of these key items.
All right. And I think Wasim Saab can also comment on this point. What are their expectations?
जी थैंक यू सोहेल साहब. जो इंटीरियम रिपोर्टिंग है उसमें फॉर्मेट में जो फ्लेक्सिबिलिटी अलाउ की है वो इसी वजह से है कि कंपनी अपने एंड पे देख के जो मिनिमम कंटेंट्स हैं कम से कम उसको उसमें कवर करे. ऑब्जेक्टिव ऑफ इंटीरियम रिपोर्टिंग का ये है कि हमें एक, क्योंकि 9 मंथ का टाइम पीरियड पे पूरी फाइनेंशियल इम्पैक्ट असेसमेंट है, तो दरमियान के पीरियड के अंदर कुछ डेवलपमेंट कंपनीज की तरफ से रेगुलेटर के साथ शेयर हो ताकि एक अपडेट मिलता रहे रेगुलेटर को क्या पोजीशन है. उसमें 2 या 3 शीट्स हैं जो आपने फिल करके अटैचमेंट लगानी है, और फिर उन शीट को फिल करने के लिए जो आपने अजम्पशंस किए हैं और जो फ्यूचर अगले स्टेप के लिए जो आपने कुछ काम करने हैं उस पे एक अपडेट है. सो उसका फॉर्मेट इज नॉट प्रिस्क्राइब बट मिनिमम कंटेंट इज प्रिस्क्राइब्ड इन द annexure.
Perfect. Thank you, Wasim Saab. Thank you, Ali Saab. The next question is it refers to the guidelines and I think paragraph 13L, and they have posted that what do you mean by qualitative explanation in paragraph 13L of the guidelines?
Right. So basically what we are saying that I will just repeat the 13L. So qualitative explanation of how a reconciliation of CSM and revenue would be performed to depict the impact of transition approach. So effectively, when you apply any transition approach, maybe full retrospective approach, modified or fair value. So if for the same portfolio, if insurer apply all these methodologies, let's say, so you will get 3 different CSM. And the impact of CSM will still be different in terms of revenue. So we are not suggesting to apply all 3 methodology, by the way, but we are saying that basically what the companies need to show the reconciliation of CSM along with in terms of revenue in a way that it will impact on the transition. So effectively, if your CSM is, let's say, decrease, so your future profit will increase because CSM is a liability. So effectively, this CSM, because it's a liability, so this will have an impact again in terms of your future profit. So if your CSM increases, your obviously revenue will decrease. So this is where we need to at least explain again how your CSM and revenue will have an impact and link together in terms of the transition approach. If you would like to add anything, please feel free. Ali or Umar.
I think यही है कि because the different transition approaches result in different values, I think we're not necessarily demanding कि it be done on all 3 approaches, but at least contemplate कि क्या impact आ रहा है of the various transition approaches on both the CSM and transition पे. Because ultimately different, especially in the context of life companies, again, because a lot of this data may be from many years ago, but it does have final impact. If you're using one approach over the other, it will result in different values. So what we're looking for is some sort of discussion on जी हमने तीनों evaluate किए, and this is what we're sort of मतलब at least, और या maybe 3 में से 2 evaluate किए, finally ये select किया because this was the one that was making more, it was more practical or back practicable, I guess, जिस तरह standard कहता है, and then the differences were sort of ये हमने observe किए थे. So I think it's just trying to get not necessarily numerical accuracy here, but looking for some sort of qualitative discussion on these aspects.
Sure, thank you. Then we have a question that how change in liabilities have the same and negative impact on the profits. So they want to understand this, that how these two are connected. So change in liabilities having the same and negative impact on the profits.
What do you want to take that? So is it referring to certain?
Yeah, it's a question that how changes in liabilities are going to have same but negative impact on the profits. They want to understand this linkage.
Yeah, sure. So Ali, you want to take it?
No, you go ahead.
So effectively what we were saying, negative impact on profit, basically, again, very simple example. I think maybe I'm using 100 million. So right now, if your, let's say 100 million is your IFRS 4 liability of unit-linked, let's say, and this includes all unit-linked liability, mortality reserve liability, everything. In IFRS 17, when you calculate the liability, this may come, let's say 90 million, right? But this may come again 110 million as well. So basically, depending on where sort of you're going, so basically that's where I just mentioned the change in liability has the same and negative impact. So it is actually depending, it's not negative impact. It will basically the concept you can see if your liabilities are increasing. Let's say by adopting IFRS 17, you were standing at 100 million, your liabilities are now 110 million. So because your liabilities are 110 million, so this means that you have taken a negative impact on equity, and that's where you will have a positive future profit with the same 10 million will have a positive impact. Same thing apply if you have a 100 million unit-linked liability, let's say, and again, not unit-linked means that the pure cash value, all total, let's say, liability, including mortality, and your IFRS 17, IFRS 17 means fulfillment cash flow, CSM, risk adjustment. When you apply any transition approach, you will get, let's say, 90 million. So 90 million means that you are sort of immediately recognizing 10 million upfront profit due to IFRS 17 adoption. So insurance company will see that my IFRS 4 liabilities were 100, my IFRS 17 liabilities are 90 million because of the transition, and that is okay. We observe based on our experience with the insurance company that for life companies, there are several reasons. For example, one of the reasons is implicit deferment. So implicit deferment was implicit deferment of, you can say, commission. So basically, initially in IFRS 17, in IFRS 4, you can say it was not allowed to defer your commission. But again, in IFRS 17, basically, it is okay to defer. So basically, and this is basically implicit requirement to defer, by the way. So there are several components which have sort of having a maybe positive impact, maybe negative impact. So for example, again, let's say risk adjustment, or maybe let's say again discount rate. So there are again several items which may have you can say positive impact or negative impact. But the point here is, if you have 100 million liability in IFRS 4, and then basically if you have let's say 90 million liability in IFRS 17, so this 10 million will be upfront profit recognition. And this upfront profit recognition means that your future profit will decrease by 10 million. The word I think maybe someone raised this question, negative profit. Obviously, this is not negative profit. It's a decrease in future profit by the same amount.
Right. And thank you. We have a comment, and they have noted that would it be possible to give an example of any product from the general insurance while filling the templates? So if we can give an example of a motor vehicle or fire policy and how it could be plotted in.
So basically, here obviously we try to explain the template, how to fill the template, and all the components. In terms of example, we did not mention, but if you see, it's, for example, again, I will try to explain right now in a very crude numbers. Let's say you have like motor UPR, let's say, and again I will just take very simple IFRS 4 example. So motor, you have, let's say again UPR, let's say 10 million, outstanding IBNR, let's say 20 million. And then basically you are applying IFRS 17, and then basically this UPR, because it's 1 year policy, that this may remain same. So you will in IFRS 17 portfolio, you will still go and extend motor UPR, which may be same. But in the outstanding and IBNR, when you provide IFRS core outstanding IBNR, this is again maybe 20 million IFRS core, and then basically you segregate this 20 million in terms of maybe discounting, risk adjustment. So this 20 million may become again 22 million or 18 million. So this will go in the IFRS 17 sheet. So effectively, the sheets are automated in such a way that this 2 million you will see immediately as impact of transition. And once you populate the profit loss account, so effectively you will see, because your starting point is in IFRS 17 is 22 million. Your liabilities has increased by 2 million, right? So we do not have example, but this is very simple in terms of if you start from 22 million, because it's your beginning liability now. So you will end up in terms of less profit by 2 million because of the same point. So again, if you want to again see from IFRS 17, especially for the life policies, so they are long-term in nature. So they have like multiple different components. You can say FCF, CSM, risk adjustment. They are absolutely new. I can understand from there. But for general insurance company, if they are following PAA, so the presentation impact is significant and is changing. But in terms of the technical point of view, UPR is still UPR. In terms of IBNR outstanding, you need to have a risk adjustment. So what is risk adjustment is you can say again, is explicit buffer. In IFRS 4, we do not provide explicit buffer. We have to provide explicit buffer. Similarly, the discount impact will still be there. So I think this is something where you just need to populate those components. So we do not have like immediately readily available example, but this is the idea here, that how you populate the template for P&L, for balance sheet, and then you will get the, I think, answers.
Sure, thank you. We also have a comment from one of the participants, and they have noted that would it be possible to provide a FIA report on any model financials covering different measurement models, so that despite the fact companies have experts, but consistency be made among all as required by the SACP. So they are requesting for a FIA report on any model financials using the measurement models. We have to see the practicality of this. So what's your take on this?
I think what was the experience in say some of the other markets? How this has been? Were there fairly standardized report? Template standardized hota hai usually, I believe. Reports may generally flexibility di jati hai to the companies, because everybody may have very unique circumstances to be able to, which they may want to describe appropriately in the report. But I don't think कोई publicly available document तो इस तरह कोई होगा किसी company का भी, which we can look at as far as FIA is concerned.
This is also my understanding, because जो banks के केस में स्टेट बैंक ने भी IFRS 9 के ऊपर इसी तरह की exercise based approach में की थी, and there was flexibility because जो भी entities हैं ये banks हैं, and internationally जहाँ तक insurance sector का है तो FIA template या guidelines तो available या regulators issue कर रहे हैं, लेकिन filled in इसको कह सकते हैं कि report या वो नहीं जैसे आप बता रहे हैं. So still जैसे उमर साहब बता रहे थे, if there are questions on the about the understanding of the template, we have a specific email address or जो कि SACP के पास भी, और SACP has shared with the insurance industry. Industry can post questions, and then the working group can see how to respond to those questions as far as the template is concerned. So we have another question that's from that's appearing in the Q&A, and the question is that how can liability under IFRS 17 and IFRS 4 in general insurance be same? The understanding is that IFRS 17 UPR are calculated using the cash information, whereas under IFRS 4 it's calculated using billing basis. So apparently there will be a difference in liability. However, equity will remain the same. So can you explain this further?
Yeah, sure. So I think, by the way, when I mentioned same, I just took the simple example in terms of the UPR, let's say, but again, as I mentioned, the maybe outstanding an IBNR because of risk adjustment or because of discounting, they may be different. And similarly, by the way, the PDR, for example, we have PDR, premium deficiency reserve, and IFRS 17, we have onerous liability. So the mechanism is different, so they may be different. And again, right now, as from my understanding, when we calculate PDR, is like total motor portfolio. The total motor means that basically we have, let's say, motor TPL and comprehensive together. And this may be offsetting, you can say, subsidizing profit or losses of, let's say, TPL and comprehensive. Maybe your TPL losses are significant, but comprehensive profits are also significant. And on consolidated basis, total, there is no need for PDR. But in IFRS 17, when we go at portfolio levels, so basically motor TPL will be evaluated separately, motor comprehensive will be evaluated separately. If comprehensive has losses, so you have to have a onerous liability or PDR. But that's a different mechanism. So that's a sort of difference in liability between IFRS 4 and 17. That definitely is there. Another question, what I understand from this question, basically there is a concept of accrual accounting and cash-based accounting. So IFRS 17 is usually, as per the standard, working on the cash-based concept. However, basically, and IFRS 17 and IFRS 4, basically we have this accrual concept. But this accrual and cash-based does not mean that they will change your UPR effectively until you have an interest accretion, which is absolutely different. So interest accretion, in very simple word, basically, if you have a, I will come back to interest accretion, by the way. But in terms of accrual accounting and cash-based accounting, what is the difference? Because this is, I think, another question in the same question. So when we booked, let's say, GWP of, let's say, 50 million of, again, maybe motor policy. So you still book GWP 50 million. You may have out of 50 million, let's say 40 million received amount, 10 million receivable, let's say. And then basically there's 40 million because they have been received. So it does not mean that you need to calculate UPR on 40 million. It does not mean at all. You have to still calculate UPR based on the book premium, which is total 50 million. The received amount is still there in the receivable. But in terms of presentation, the receivables are part of the LRC. So they will be netted off. So we do not need to, you can say, go back to, because it's cash-based accounting, so that's why there should be a difference. It's not like that. And again, there may be another difference, as I mentioned, to interest accretion for more than 1 year contract. If general insurance companies are following PAA, which is, you can say, relatively simple as compared to, again, especially for life companies. So basically here you have this concept of more than 1 year, you have to mandatory discount liabilities. Let's say if your motor IBNR is having a tail of more than 1 year in the triangle, let's say, you expect that you will settle motor liability claim after 1 year, 2 years. So you have to discount liability. Similarly, if there's a UPR, let's say engineering policy. So there is a UPR of engineering policy, and engineering policies are usually more than 1 year, usually. So you have to calculate interest accretion on the UPR itself. That's a change in terms of the mechanism. Why we are applying interest accretion? Again, insurance, this IFRS 17 works on a matching principle. So the matching principle means if you have to discount liability, you also have to accrue interest on the liability. So it's just simple. If you take a loan from bank, right? This is just very normal daily routine life. If you take a loan from bank, you have to pay interest. So if it is more than 1 year, in standard requires a mandatory requirement to accrue interest and mandatory requirement to discount liability. That's the another change in terms of the IFRS 4 and 17. So in very, very simple word, there should not be any impact because of the accrual or the cash-based accounting, but there is an impact of UPR, interest accretion, risk adjustment, discounting, level of aggregation, owner's contract. So these are the various categories where IFRS 4 and 17 may have differences. However, for general insurance company worldwide, it is very clearly observed that general insurance company will have less impact as compared to life companies, because if they are following PAA, by the way. So otherwise there will be significant impact. I hope I answered that question.
Thank you for the detailed answer. We have no further questions. So thank you, Mohit Saab, thank you, Ali Saab, for very comprehensive presentation and detailed explanations. Thank you.
Okay. So,
and now I would request Wasim Saab for his thoughts.
Thank you, Sohail Sab. First of all, I'd like to thank Moeed and Ali for this brief session on the template, and they provided a very detailed overview of the template and the guidelines. We expect that we are moving now from the first level of interpretation of IFRS to the second level of interpretation to the financial impact assessment after a tenure of 4 years. And when we started this project in 2018, and then there was some setbacks in the interim periods, but we expect that now we will move inshallah in the next phase of system design and implementation fast after completing this financial impact analysis. And we expect that the industry will cooperate and provide the necessary resources for this assignment. And we, being a regulator and the technical working group, will provide the necessary guidance and support to the industry regarding, as we share that, we will share with them the email address on which they can ask the question relevant to the templates. And we will also try to provide some link of the international guidelines, publicly available international guidelines available on the IFRS 17. At the end, I have special thanks to the ICAP that they provided this support and arranged this session. And I also special thanks to the Umar Murshid Saab for providing their guidance and running this whole project. Thank you.
Thank you, Wasim Saab. I think we can now close the session. And once again, thank you to all the participants for attending the session. And as Wasim Saab and Umar Saab have already mentioned, that the working group is there, and the working group would be facilitating the insurance industry in implementing the standard along with SCCP. So with this, we end the session, and we once again thank Wasim Sahab, Gibran Sahab, Umar Murshid Sahab, and our presenters. Thank you, everyone.